What's going on, everybody? Welcome back to the channel. In today's video, I'm going to be going through a simple market structure strategy that you can use to simplify your trading and make things a little bit easier. So if that sounds interesting to you, make sure to stick around to the end of the video. Make sure to like, subscribe, and let's get straight into it. Alright guys, so first of all, I have written up a little trading plan to make this strategy a lot more simple. So the first step that we're going to use is just to simply identify higher time frame trend and market structure. If you don't already know how to do that, I'll leave a link to a video either in the description or I find a way to put it up here, to a previous video that I did about how to do that very simply. But in case you guys didn't want to go and watch that video, I'm just going to do a simplified version of it just here on TradingView. So what I mean by market structure is we're going to be looking at whether higher time frame is printing either lower lows or lower highs, or higher lows and higher highs. And then we're going to be identifying any breaks in the trend at significant areas of supply and demand. So if we are dealing with a trending market, this is going to be the first sort of scenario that we can have, is if we actually have price in a very nice trending situation where we are going from higher low to higher high, higher low to higher high, just like this, where price is printing a series of pullbacks and maintaining this overall uptrend. And of course, we can also have the opposite when we are printing lower lows and lower highs, like so. So that is what I basically mean by identifying market structure. The third scenario that we can have is when price is possibly reversing trend. So we're printing, say, higher lows and higher highs, and then price actually breaks below the most recent higher low. That would be our change of character. It's a break of structure in the opposite direction to the trend. And then in this scenario, we wait for a retracement into a level of supply to then short the market back down in anticipation that it is going to be now forming a new trend. So the opposite trend being a downtrend in this scenario. Obviously, you flip that around if we are going from a bearish market to a bullish market. Very simple stuff. So that would be the first step in the strategy. And of course, I'll go through a few examples in a moment. Second step then is to go and highlight your higher time frame areas of interest. And I think this is where a lot of people go wrong with this type of strategy. So the price action strategies, or smart money, if you want to call it that, is people don't have set parameters and specific things that they have to look for every single time when identifying higher time frame areas of interest, because that can be quite a subjective part of the trading plan. So for that reason, I've outlined the criteria that we can use every single time to make sure that our higher time frame areas of interest are always consistent with these rules. So I've got two main types of points of interest, or POIs, that I like to look at. The first one is if we are in a nice trending market, we look for a pullback to an area of supply or demand in a trending market, obviously. POI type 2 is after the trend is broken, we wait for a pullback to an area of supply and demand that caused the break in structure. So if I go ahead and show you what that means exactly right now. So for POI type 1, we are simply waiting for price. If we are in a trending market like this, we wait for price to retrace into, if we get out the box, an area of demand, like so, in line with the trend. So price didn't break below the most recent higher low, therefore we are still bullish. We wait for price to retrace into some sort of area in line with the trend, and then we look for our lower time frame entry model, which I will go through in a second, for then further buys to take out that most recent high of the trend. And then in a downtrend, we also have similar sort of scenario. We wait for a pullback into an area of supply like this, and then we also look for that lower time frame entry model to give us confirmation that price is likely to continue to the downside. POI type 2, like I mentioned, is when we actually have the higher time frame trend broken. So what we're gonna be looking for in this scenario is, if we're looking at an uptrend, We have price printing higher lows and higher highs. We then break that trend like this. We clearly close below the most recent structural low, in this case a higher low, and then we wait for a retracement into an area of supply that caused the break of structure, and it is also at a premium of the current range. If the area of supply is, say, here at the bottom of the leg, that makes it invalid since it isn't at a premium. And what I mean by a premium is that if we draw the fib tool on from the low to the high, so from the current high to the current low, before it starts pulling back, we want to make sure that the POI that we are looking at is at least above the 50% of that range, and also ideally in a perfect scenario above 70% as well. And like I said, I'm going to go through a few criteria for these points of interest and supply and demand areas as well right after this. So if we go back to the trading plan, now that we understand what the POIs are that we're looking for, so either a pullback in a trending market, or we wait for a break of structure and then a pullback to those premium levels of supply, or discounted areas of demand in the reverse case. Right, so the three main things that I want to see for the POIs is they must be obviously imbalanced. I'm talking about areas of supply and demand, by the way. So it always has to be an area of supply and demand. It always has to be imbalanced. If it's not in imbalance and it is already efficient, meaning that price has filled in any inefficiencies in the market, then most of the time I won't take a trade off of that. So for the purpose of the video, we'll say that is invalid, just to simplify things. We have to see liquidity being generated above or below the zones, as there's a common saying in the market that if you don't have any liquidity above or below your areas of interest, then you probably are the liquidity. So we want to be making sure that price is generating early buyers and early sellers either above or below our areas of interest. That's another key thing that we need to see. And like I mentioned before, we need to see that the price, the areas that we're looking at are either in a discount or a premium of the current trend leg, which means that it is below or above the 50% if we draw the fib tool from the low to the high like I just did. And then step 4 is our lower time frame entry model, and this is going to be as simple as possible. We want to see three things: sweep of liquidity, break of structure, and then we wait for a retracement into a level of supply and demand that caused the break in structure. So if I go ahead and draw that as a diagram to make it more simple, so imagine that we have this area of supply on the higher time frame. That is our higher time frame point of interest. Like I mentioned, that was step 3 of the trading plan. Step 2, sorry. Now we move on to the step 4, which is the lower time frame entry model, and this is going to be the exact same thing every single time. So we go to the lower time frames, and imagine if this is an area of supply on the higher time frame. On the lower time frames, we would be trending bullish up to that level, as obviously price is going up. Therefore, we are printing higher lows and higher highs on the lower time frame. And what we want to wait for is for price to generate some liquidity, sweep the liquidity, and then break structure. So it has to break the most recent low that caused the break of the high. We break below that, that's our change of character. We then wait for a retracement into the area of supply that swept the liquidity, and then we simply set a limit and we sell down. And as for targets, we are targeting liquidity areas or supply and demand areas where price is likely to reverse from. You can also obviously tailor this to your specific personality type or how you like to trade, and target things like maybe a 1-to-1, 1-to-3, set risk to reward if you prefer to trade that way. Personally, I like to do it this way in order to maximize the winning trades and the runners that I have, is just to target the liquidity areas or supply and demand where price is likely going to gravitate towards. So as for what this actually looks like in a live situation, I'm going to go through 2 examples now. One was fairly recently, it was on USD CAD. And if we go back to here, so at this point in time, on the 4-hour time frame, USD CAD was clearly still bearish. So that is step one of our trading plan, is to highlight the overall market direction. Obviously, we are trading down, we are in a downtrend. And another thing that I didn't mention actually, when we're identifying the higher time frame trend and market structure, we want to make sure we actually draw on where the key structural points are. So in this case, if we're looking on the 4-hour, we have this break of structure to the downside. This is the most recent lower high. This is the most recent lower low. So now we are anticipating a pullback into a higher time frame area of interest for then further sales back down. So in this case, we go back to the trading plan. Identify higher time frame areas of interest. That is step 2. In this case, we are obviously looking at the POI type 1 because price is trending down. We haven't had any breaks of structure in the opposite direction to the trend. So we're waiting for a pullback into a premium level of supply. I remember I said it has to be in a premium, meaning that we are above the 50%, but also ideally above the 70%. So we go to the criteria for the points of interest. Has to be in balance. We have to have liquidity above or below, and is in a premium of the current leg. And what the level that stood out for me was this one up here, as this was an imbalanced level of supply. It swept liquidity to the left, and we had liquidity below it as well in the form of this sort of trend line, where people were selling early without waiting for a pullback into this level. And it is obviously in a premium of the current leg. And in this case, it is also the extreme of the current leg, meaning that is the very top of the current leg of the trend. So now we simply set our alerts and wait for price to come into that level. And once price is in that level, I like to change the color of the zone just to make it a little bit more clear. And now we are waiting for that lower time frame entry model. So remember that I said, first thing we look for is for price to sweep liquidity and break structure in the opposite direction to the trend. So in this case, on the 15-minute time frame, we are trending bullish, even though on the higher time frame we are still bearish. Obviously, if price is doing a pullback on the higher time frame, that is going to be bullish on the lower time frame. So simply we wait for this trend to show signs of reversal. And we got that in this case. So we have sweep of liquidity. Notice how we had these sort of 4 equal wicks where price was moving down. This is where people were selling early. We then went up, liquidated all of these people. And second thing is we also had a break of the most recent low. That is change of character, meaning break of structure, but in the opposite direction to the trend. So in this case, a break of structure would be price printing a higher low and then breaking the higher high. That's the break of structure. But change of character is in the opposite direction to the trend. So we have a break of the most recent higher low to form a lower low. And then looking at a step 4, sweep of liquidity, break of structure, retracement to supply or demand that caused the break. In this case, we're looking for sales. So we're looking for a retracement into an area of supply that caused the break of structure. And in this case, we have this very nice area of supply, which was imbalanced. And we also had liquidity resting below, like so. So it meets all of our criteria for a point of interest. Is imbalance, liquidity is below, and it is in a premium of the current leg. So on the lower time frames now, the current leg is from this low to this high, and this is obviously in a premium of that current leg. So simply all we do now is set a limit, stops just above the high, allowing like a little bit of room, because sometimes these areas like to be whipped out and then price will go in the intended direction. And as for targets, we can target liquidity levels or previous levels of supply and demand. In this case, it's fairly obvious that this wick is going to be taken out, and that would give us 5.5 hours, which I'm happy with. We obviously don't want to target like all the way back down here for like a 1 to 30. That's quite unrealistic. So we'll just go for this wick just here and see what price does. There we go. So TP was hit. And had you targeted all the way down here, as that is the most current trend low, you would have been stopped out. So it is better to take the 5.5%, despite what other people say that is a good return. And I'd be completely happy with taking my profits at that sort of level. So the second example then is going to be an example of the type 2 POI that I mentioned. And this is going to be GU in January of this year. So looking at this, we look at this trend just here. GU was printing a series of higher lows and higher highs, and we were bullish. However, when we came to this sort of level, which if we look left was an area of liquidity, that price took out. And it also tapped into this imbalance above as well. Once we tapped into that liquidity level, price on the higher time frame, in this case the daily, shifted structure because we took out this most recent higher low. So that is our change of character. And what we also can see is that at a premium of the current leg of the trend that's just formed, so from the low to the high, we have formed this imbalanced area of supply with a little bit of liquidity resting below as well. So this becomes a higher time frame area of interest that we are looking at. So if we just play price on, what we're looking for now is that lower time frame entry model once price comes into our area. And like I said before, I like to change the color to make it a little bit more clear. So going to the lower time frames and looking out for our entry model. Not seeing anything yet. These single candles aren't really pullbacks for me. For a pullback, I'd ideally like to see something a bit more clear like this, where we have those 4 consecutive bearish candles. One single candle isn't really enough for me, and I wouldn't consider that a break of structure. So if we just play price on a little bit more. Okay, so now price has formed this higher low and this higher high. So that is our break of structure just there on the lower time frames. So now what we are waiting for is obviously the break of structure in the opposite direction to the trend, and see if we get that. There we go. So price took out this structure. That is our change of character. And remember I said for the lower time frame entry model, we also want to see sweep of liquidity, which in this case is a sweep of this high. So a lot of the times you'll see when price comes into these higher time frame areas, you get an initial push down from the area, then we get a sweep of the initial sellers, and then price will break the structure, and that counts as a sweep of liquidity. So if we just draw this across, you'll also, most of the time you'll also notice that when we get a sweep of liquidity, you get like a bullish candle like this with minimal wicks on either side, which looks like it creates a higher low and break structure. And then immediately after, you will see it just impulsively melt over to the downside and take out structure. That's how you can know that a reversal is likely. And then in this case, as for an area to get in the trade, we have this candle, which was the one that swept liquidity. It's a premium level of supply, and we also have this area which I'm seeing as liquidity below as well. In this case, however, I would be waiting for a second confirmation going lower time frames again. So in this case, we're on the 30-minute. When price pulls back into this area, I'll be looking on the 5-minute or lower for an entry confirmation, as I'm a bit hesitant to enter just off of this zone, since it was already filled and mitigated. So if we wait for a pullback, like so, and the lower time frame entry model, once again, sweep of liquidity, break of structure, and then this was the candle that swept the liquidity and caused the break of structure. Therefore, this is the area where we set the limit. Stops a little bit above, and then for this, I'd probably target, if we look on the higher time frame, you could probably get away with targeting this area down here, as like I said, this POI that we were looking at was a daily POI, so we are likely to see some quite bearish moves from this level, and the trade tags us in straight away. Now we just let it play out. Going on the higher time frame, another confluence for targeting this area. We have all of this imbalance down there. Price came into a premium, so we are likely to retrace down into a discount. And there we go. That would have been a nice 1 to 7. So yeah, to summarize, we highlight our overall market direction and our market trend using the principle that I told you in the start of the video. We then highlight our higher time frame areas of interest, which for criteria, we need imbalanced areas of supply and demand, liquidity above or below, and we need them to be in a premium or a discount of the current trend leg. And we highlighted the two different types, one being a pullback in a trending market, the second being after a break in the overall trend, we wait for a pullback for then a possible reversal. Lower time frame entry model, we want to see a sweep, a break, and then a retracement to the candle that swept liquidity and caused the break. And then we're targeting liquidity areas either below or above, depending on the direction. And it's as simple as that. If you guys found this video useful, make sure to obviously like and subscribe. And if you have any questions about this strategy or any of the intricacies of it, make sure to leave that in the description box below, and I will answer them as quickly as possible. But yeah, thank you guys for watching, and I'll catch you in the next one.